Morning, and welcome to RetailInvestorConferences.com. My name is Bradley Smith, Director of Marketing at PR Newswire. And on behalf of PR Newswire and our co-hosts, Better Investing and Monk Media, we're very pleased you have joined us for our next live presentation. As you read on the agenda, we have a full day of both CEOs sharing their company's vision as well as educational seminars to help us all be smarter, self-directed investors. Before I introduce the next presentation, a few quick points. Please ask questions in the question box below the speaker's photo. Getting questions in real time from you is essential. Let the presenters know what is important to you. Also, ask a question when it comes to you. Otherwise, if you're like me, if you're late to the end, you may forget your question. Questions will be answered as time allows at the end of the formal presentation. Once the Q&A session has ended, don't log out. You will automatically be transferred into the company's virtual trade booth, where you can continue to ask questions via chat. You'll also find a library of shareholder materials, as well as links to the presenter's website and other key information. Lastly, all presentations are recorded and are available for 24/7 replay at your convenience. At this point, I'm pleased to introduce our next presenters, Victory Energy Corporation CEO Kenny Hill and CFO Mark Biggers. Kenny?
Thank you very much for that introduction. Good morning, everyone. As the introducer said, I'm joined today by CFO Mark Biggers. I'll be trying to cover as much information as possible in the short time we have. I'll get started by talking a little bit about the Safe Harbor Statement. Please be advised that we'll be making forward-looking statements during today's presentation. Those statements are not guarantees of future performance. Please take the time to review the statement on slide 2, as well as the risk factors in our 10-K and other SEC filings. All economic assumptions in this presentation related to specific wells or specific prospects are based on technical analysis performed by reliable third-party geologists and reservoir engineers. These are not economic forecasts. So let's start with who is Victory. Victory is a publicly traded independent oil and gas and exploration company. Our investments are focused on long-lived oil and liquid-rich plays within the domestic United States. Currently, our producing assets are located onshore in Texas, New Mexico, and Oklahoma. We concluded Q1 with a held acreage that provides the opportunity to drill 31 gross wells. The April additions of the Chapman Ranch and Lightning prospects have added a minimum of 10 new well locations, with 8 of those at our 25% Lightning prospect. We also have line of sight to additional high-value prospects beyond our current acreage, similar to the Lightning prospect. Our current 2012 capital budget includes up to 18 wells, with the primary source of funding likely coming from Navitas Energy Group, our partner in Aurora Energy Partners. I'll discuss those in more detail later. Our long-term objective is to increase our oil reserves, improve financial returns, and manage the capital on our balance sheet. For those of you that are familiar with our company, you're aware that Victory's recently emerged from a multi-year turnaround period. Our first fully compliant 12-month SEC reporting period was reached on March 31st of this year, thus giving our shareholders the most regulated transparency since the founding. We're very proud of how far we've come and pleased to now be fully focused on growing the company and generating shareholder value. This is a rather busy slide, but I'll go over just a few of the highlights for you. In January, we rounded out our new management team. After 12 months with the company, I was promoted from Chief Operating Officer to Chief Executive Officer, and Mark joined us from a distinguished career in the energy practice of Alvarez and Marsal to become our Chief Financial Officer. During Q1, we relocated our headquarters and back office support to Texas from California. This move will significantly reduce our G&A expenses going forward by over 40% from last year. We also cleaned up the balance sheet. As of February end, we had no debt and $1.7 million in cash, allowing us to quickly begin acquiring new assets like Lightning that can provide significant growth opportunity for the company. And as you will see during the rest of this presentation, we've developed a conduit to access new investment capital that will provide a foundation for the execution of our comprehensive growth strategy. Mark, why don't you take the next slide, please?
Very good. Thank you, Kenny. This is an interesting slide. You can see that since the end of 2011, we've increased our market capitalization and grown cash on hand over $1.5 million. during January, we raised $1.8 million of new capital, and as soon as that was done, we closed the related private placement process and then immediately retired all senior convertible debentures. All the debt was gone. We have zero debt on the balance sheet, and we're making significant improvements in our proved development reserves at this time. As anticipated production increases from our core assets, and that's, for example, our wells in Bootleg Canyon, our discovery well in Uno Mas, you're going to see our profitability and balance sheet is going to improve. I know you haven't seen that yet, but as the year unfolds, you most certainly will. I would just say, as discussed previously, we've now completed the company turnaround process that started several years ago. The conclusion at the end of quarter one is going to mark the end of a substantial operational and financial cleanup, and we're going to begin the most significant expansion in the company's history. So we look forward to the future. Kenny, back to you.
Thank you, Mark. We've now assembled an executive team with over 107 years of oil and gas exploration and production-related experience. This single achievement is the primary reason we've been able to fully turn around the company while building a deal pipeline that companies several times our size would envy. I joined Victory at the beginning of last year as Chief Operating Officer, became the Chief Executive Officer in January of this year. My background includes extensive hands-on experience in business development, operations, and leadership at a variety of successful companies. My most recent executive experience was with another publicly traded exploration and production company as interim CEO. We're very pleased to have Mark join our team in January of this year as Chief Financial Officer. Mark served over 30 years in the oil and gas industry, including 22 years at Mobil Oil. Most recently, Mark spent the last 6 years working in the energy practice of Alvarez and Marsal, working with firms such as Encana, First Reserve, New Star, and Stan Lindsay, our Vice President of Exploration and Development, has been with the company since I joined. Stan is a certified petroleum geologist with over 30 years of experience in exploration, development, operations, acquisitions, and divestiture. David McCall is a member of our board and serves as our general counsel. His expertise encompasses all aspects of oil and gas operations. David's recognized by his peers as one of the top oil and gas attorneys in the United States and is a key contributor to the growth of the business. Mark, why don't you take slide 7, please?
You bet. So, take a look at this slide, and you can see that the key financial deliverables involve increasing reserve, improving returns, managing the balance sheet, and I'll focus on certain items within that. So during the first quarter, we paid a lot of attention to getting the turnaround and remediation work behind us. Then we set about defining strategy and implementing on that strategy. So one of the ways that we're increasing reserves now is by leveraging our internal technical capabilities, and that's led by Stan Lindsay, who's Kenny's talked about before. And the idea there is to identify new oil and gas opportunities where we can get in early and take a larger stake. So what's different? Well, basically the deal flow now is more of a two-way street than in the past. And also, when you've got internal capabilities, you can often pursue a larger working interest position. When that happens, with a quality play, that'll translate into more substantial revenue stream that covers our cost base and then even yields additional profitability on top of that. As far as then improving returns goes, I'll touch on a topic that Kenny mentioned before, and that was reducing cash G&A cost. So 2011 definitely had significant accounting, consulting, and other legal charges that we incurred that were not of a recurring nature. It had all involved getting current with SEC reporting compliance, and we've done all that. But even setting those non-recurring pieces aside, we are going to cut our G&A burn rate beginning really in April of this year. And we're doing that by having an in-house management team versus interim personnel. We've moved the back office to Texas. We're moving other professional services here to Texas, and it's just more cost effective. And it's nice having all the operations in one place. So I would say, again, looking forward to the rest of 2012, we have planned production increases from our discovery well at Uno Mas. We've got Bootleg Canyon development drilling and other plays that are going to contribute to improved profitability over time. And taking a look at that balance sheet, during the first quarter, a lot happened. We completed a reverse stock split and converted all the outstanding debt to equity. Now when that conversion happened, there was a one-time non-cash finance charge associated with the conversion. That's the only bad news, but the good news is that there's no debt on the books. And with no debt, the company is much better able to gain access to new capital that we need to grow. And in the near term, we're going to be utilizing the capital structure available through our Aurora Energy Partners agreement. And that agreement allows for Navitas to advance us up to $15 million. That's one avenue, but again, we'll also evaluate other third-party sources to fund our growing portfolio of opportunities. So as the company grows, we'll be looking for the best ways to finance the larger opportunities that are available to us, likely through a combination of debt and equity, possibly some asset sales where appropriate, and of course, ongoing cash flow from operations. Kenny?
Thanks, Mark. Operationally, we have a three-pronged approach to asset acquisition and development. This is quite a bit different than what you may have seen last year in our communications. First, we have our existing assets, which were primarily acquired in 2011, in which we have working interest ranging from 1 to 10%. We currently have 17 producing wells withheld by production acreage that offer additional drilling opportunities. We'll carefully manage these assets in order to generate funds for future investment. This will include drilling new wells, optimizing existing wells, and the potential sale of assets as better opportunities arise. Most of our new investments in 2012 and beyond will target larger working interest projects. That's to add to the business section of this slide. This approach generally allows us to have lower finding and development costs and larger economic upside. We also have access to multiple very large oil shale resource prospects, which we'll discuss in more detail in a few moments. The combination of these three strategy elements, I think, allow us to aggressively build the business, but do it in a mature kind of way. Let me move on to slide number 9. In 2011, we began emerging from our turnaround efforts and began making our first oil and gas investment since 2009. Total capital expenditures to acquire, develop those assets last year was about $1.1 million. That was significantly weighted towards the back half of the year. In total, we participated in 9 gross exploration wells and acquired an interest in 3 gross producing wells. We also acquired a 2% working interest in the Atwood waterflood project located in Oklahoma. As I mentioned earlier in the presentation, we've identified 31 gross drilling locations in the properties we acquired last year. Of those, we expect to drill up to 18 wells in 2012 at an average working interest of about 14%. The average working interest can increase to 24% if we choose to develop the Tippett Shale opportunity at our Adams Baggett wells. We'll talk more about that later in the presentation. With the recent addition of the 2 Chapman Ranch prospects and the 8-well opportunity available to us at the Lightning prospect, our 2012 capital and expenditure forecast is in the neighborhood of $3.5 to $4 million, depending on drilling schedule and other factors. Please note that this dollar amount is an update to slide 9 in this presentation. Let's now address the first element of our business strategy, optimizing and developing assets, our existing asset base specifically. This next slide shows the 3 what we call our high-impact assets from last year. Let me first start with Uno Mas. This Lee County, New Mexico reentry prospect was a previously producing oil and gas well, but had been plugged in 1995 due to low oil and gas prices. Victory participated in the reentry of this well for the purposes of restoring production and the opportunity to increase flows by fracking numerous pay zones identified in the well. The well was successfully reentered, flow tested at rates higher than the previous pre-flood production volumes. The well was later fracked and has been flowing both oil and gas at reduced rates since December 23rd of 2011, again a back half of the year project. The well is continuing to naturally unload the frack fluid. At the request of the operator, VF Petroleum, we've not yet disclosed flow data to the market. We anticipate flow rates to be above the pre-frack test levels, though, and occur after the well is completely unloaded the remaining fluid. The analogous well for the Uno Mas, just as a little background, is from Devon Energy. It's called the South Shoebar 15 Stake 2. That well has a cumulative production of 4 BCF of gas and over 90,000 barrels of oil from December 1999 to present. So it's a pretty long life well. That well achieved maximum production 9 months after it was fracture stimulated. So for some perspective, the Una Mas well was fracked 5 months ago. So we think we still have a little bit of unloading to do before that well reaches the kind of potential we believe it's going to have. I'll address the second project, Adams Bag, in a little bit more detail because it includes some descriptions about a shale opportunity. Let's move on to the Bootleg Canyon play, which is also operated by VF Petroleum, same operators in Una Mas. Our first well in this play, the University 6 number 1, was completed last June and was later recognized as a discovery well by the Texas Railroad Commission. Pretty significant accomplishment. Since then, we have run extensive new 3D seismic and expanded the property from 1,600 to 4,911 acres. The initial well test flowed at a daily rate of 252 barrels of oil and 300 MCF of natural gas with tubing pressure of 600 psi. In March of this year, we announced plans to drill a second well on the property. This new well is our first development well. That's an important distinction. It's a development well, and with a successful completion, production should accrue to cash flow immediately. The other important element of this well is it will also help us calculate and report proved undeveloped reserves for the first time in the history of the company. As we've communicated in prior press releases, we believe there's a significant reservoir in this area, and we have to test it and prove it up through drilling. Second well will help us do that. It spud in April, and as of today, it's nearly 6,000 feet into the drilling program. Target depth is 7,200 feet, and it's expected to be reached in the coming week or so. When that well is completed, we'll announce it to the market. We own a 5% working interest and a 3.75% net revenue interest in this project. That includes property and wells, obviously. I'll move on now to the next slide. We have smaller working interest oil and gas assets, and these are some of the ones we really started acquiring in the beginning of the year, although we have added to that recently. These 3 small working interest projects were acquired in 2011. The Atwood and Jones County plays are conventional multi-well drilling programs. The Clearwater play was our first investment in unconventional resource play. All 3 prospects were working interest acquisitions that included both producing wells and large land positions for possible future development. In the early stages of the company, we felt it was important to acquire larger opportunities to drill so that as capital came into the company, we could have a drilling program ahead of us instead of trying to acquire new prospects all the time. Our business has changed quite a bit since the beginning of 2011, as you'll see in a minute. Since the last market update for Clearwater, we've added a 3rd well into the production. The Sage number 1 came into production recently and is matching very well with the first 2 Hamlin wells in terms of production that you can see on this slide. Each of these wells typically have EURs between 20 and 45,000 barrels a day, and there's a multi-well drilling program, again, on all of them. Both of these prospects are now in a drilling pause. Specifically, or all 3 of these prospects are in a drilling pause because the operator is doing geological analysis as it relates to the improvement completion procedures. The primary goal is to increase initial production volumes and improve overall finding and development costs. These are shale plays. Most of them now are shale plays, and with that, you're constantly trying to improve the completions through different frac procedures, that sort of thing. So a pause is a normal part of projects such as these. We'll keep the market updated as more information becomes available. Now I'd like to move on to our most recent acquisition, a prospect called the Chapman Ranch prospect. This is a 3D seismic control 2-well prospect. It was added to our portfolio on April 3rd. The first well has been permitted, the site work is complete, and a rig's been identified. So we expect drilling to commence very soon. Again, when that well spuds, we'll make that announcement. This is an exciting prospect for us. With success at the first well, a second well will be drilled shortly thereafter. Both prospects are supported by 3D seismic, and just as importantly, are up-dipped from multiple producing wells, had initial flow rates of 150 to 250 barrels a day. We expect better than that because of the up-dip status. Based on the seismic data, evidence from existing wells, internal and external analysis, we estimate that a successful well at Chapman contained 375,000 barrels of oil. That's a single well. And deliver over $410,000 per year to our 5% interest. Please note that this slide shows a $1.5 million gross per well cost. That's accurate. However, we expect our cost to be approximately $77,000 to our interest. for that well. Now let's move on to the Adams Baggett prospect. This is actually one of our legacy pre-turnaround assets. It was the original asset purchased by the company a few years ago. It's been generating production revenue from liquid-rich gas since 2008. This site currently has 9 producing gas wells, of which we have a 100% working interest in 7 and a 50% working interest in 2. We're very excited about this acreage because of the emergence of the Tippett Shale, which is being explored by other operators in the region, such as Devon Energy, EOG Resources, Pioneer Natural Resources, Peak Energy, Malopo, Approach Resources, and Nadell and Guzman, very active Permian Basin operators. We're currently evaluating the possibility of recompleting our existing wells in this Tippett Shale zone. A new exploration well has recently been spud just to the northeast of our property. We anticipate that this well will be fracked and completed in the coming month or so, and then unload frack fluid for a short period after that. Upon completion and further study of that well, we're going to make a decision to move forward or wait for better and more complete completion type data. If we choose to move forward, the data suggests the following. We estimate the recompletions, including the fracture stimulation, would cost about $340,000 per well. And remember, we own the vast majority of the working interest in these, 175, and could result in production of approximately 30 barrels of oil per day. It may not sound like a lot, but when you own 100% of the well, it produces significant payback, in this case less than 6 months, and can produce between $500,000 and $900,000 per well to our interest, to the 100% interest specifically. This is an exciting opportunity, as you know, as shale opportunities pop up all over the country. Places that used to only produce gas or never produce anything are now becoming viable resources and opportunities to develop. And that's the case for Adams Baggett. We're very excited about that. As you can see, as we're talking about our projects, we've got kind of a cluster of them, but in general, we're pretty well geologically and geographically diversified. We plan to continue to keep the case. The next element of our strategy is really kind of the key focus for our growth, and that's acquiring 25% to 100% working interest in high potential oil prospects. That's a shift from the smaller 2 to 5% that we talked about earlier. The first prospect and probably the most important acquisition in the history of the company is this project that we call the Lightning Project. The Lightning oil and gas play, which we announced in late March, is very significant for the company and our shareholders. This is our first acquisition under the new strategy. We have a 75% working interest and a 56.25% net revenue interest in this 320-acre asset. It's located in Glasscock County. We expect to farm out a 50% interest to a third party prior to drilling the first planned well in August of this year. The target formations are shale plays, including the Klein, Wolfberry, Fusselman, horizontal Wolfcamp. We plan to drill at least 8 vertical wells on this property, with an opportunity to drill 16 total wells with a 20-acre downspacing allowance. The plan is to drill 2 wells and then downspace to 20 so we can drill up to 16. Other operators have done that around the acreage and other projects. Vertical wells are expected to have estimated ultimate recovery rates of 115,000 barrels to 228,000 barrels of oil equivalent. Those are recovery rates per well. Let's go to the next slide and look a bit closer at what that kind of recovery does for the company. As I said, we're very excited about this. The production and reserve assumptions shown down at the bottom left corner of this slide are based on a third party and our own internal analysis of the formations and the wells that surround us. 4 wells abut our southeast property line that have cumulatively produced over 4 million barrels of oil. A single well to the northeast of the prospect acreage had 184,000 barrels of oil equivalent recovered, while another to the southeast had 331,000 barrels of oil equivalent recovered. A company by the name of Meritage Energy Company has been drilling these types of wells in the area for quite some time, has perfected the completion procedures in these wells, specifically the frac and completion procedures, and are now averaging 228,000 barrels of oil equivalent per well. For base case financial planning purposes, Victory Energy plans to use 115,000, which is on the low side of this chart, a mid case of 175,000 barrels of oil equivalent, and a high case of 228,000. Health acreage currently provides 40-acre spacing, as I mentioned before, with an opportunity to go down to 20-acre. With the 20-acre spacing opportunity, we can drill 16 wells in this property. It will take us about 2.5 years to drill that based on rig availability and frac equipment today. But utilizing an average EUR of the 115, the lower number, these wells could deliver a total of 1.8 million barrels of oil equivalent, or the equivalent of $165 million in gross income at $90 a barrel to the 100% interest. That's a big number for us. Estimated production to our 25% working interest in the single prospect is larger than our entire company today. I'll say that again. Estimated production to our planned 25% working interest in the single prospect is larger than the entire company today. We're really excited to have this prospect in our portfolio, and I think it says a tremendous amount about the quality of deals that we have access to and our management team's ability to get them done. If you'll visit our booth, our little virtual booth after the presentation, you'll find a PDF document available for download with more details about the Lightning prospect. It's also on our website. Now let me move on to slide 19. These are this is a new area for the company, internally generated prospects. During the past years, we've been developing internal resources that are capable of producing our own prospects for drilling. We're now finalizing our acreage acquisition here in Texas that may provide for new drilling later this year. It's simply a matter of priorities. With the Glasscock prospect and some of the better prospects that we have available and our focus on finding a development cost, this is a great well, but there are better opportunities in front of us. As we work with our 50% partner on this well, we'll acquire the land, immediately hold the acreage, and then drill on it when the opportunity is right. Let me move to the next slide. The next element of the strategy is acquiring a resource play on development acreage. As many of you know, there's a big move all over the United States for the last several years to acquire large shale, whether it's or Eagle Ford or any number of things. As we move into discussion of this strategy element, I'd like to take a moment to just give you some background referencing that. As resource plays have developed around the United States, we've seen a number of companies do really well and others that have overestimated the long-term commodity price of gas and are now struggling and selling assets. One consistent component of successful companies has been to learn from the leaders in the play and get ahead of the cost curve associated with the underlying mineral rights. Almost without exception, every resource play in the country goes through an extended drilling and completion learning and cost curve. The big exploration companies will drill dozens or hundreds of wells before they ever find the right formula for completions. Then that produces optimized and consistent production rates. For companies our size, entering a play at the right time is absolutely critical to the success and proper use of capital. I'd like to talk a little bit about that. As demonstrated on this slide, we believe the optimal entry point is just after the completion techniques are consistently producing repeatable results. Not good results, but repeatable results. In the case of the Wolfcamp Wolf-bearing Tippet, we believe that time is just starting to occur. For the last 8 months, we've been reviewing operator data across the Permian Basin. 2 operators reached near repeatable results last November and December and have carried that into this year, with the most compelling changes being made in the completion technique used and the length and number of frac stages per horizontal leg. In some cases, the frac stages are over 7,500 feet and go up to 30 fracs in that stage, or 30 stage fracs in that leg. The ability to scale a drilling program in these oil shale opportunities, we believe, is now upon us. During the same period we've been reviewing the data, we've also reviewed several large-scale mineral lease opportunities, and we've actively begun discussions with potential capital sources and the operators that have shown successful track records in the play. While we work with our capital sources on the already identified prospects, we'll continue to review additional opportunities in this shale trend. Slide 22 provides a little bit of a snapshot of the kind of economics that are available. This is really a summary slide of the deals, various deals that we've looked at. As you can see, the numbers are large and they require a lot of capital, which is not always easy to get for a company our size, but something we have had open conversations with and will continue to pursue. A couple of points to look at in this slide. Development acreage usually exceeds 2,000 acres. If you think about 7,000-foot laterals, you have to have a lot of acreage to drill those wells. And of the 2,000 acres, mineral rights typically range between $1,000 and $3,500 an acre for property that's ahead of the development trend, but not so far from it that risk outweigh the reward. Initial acquisition costs for mineral rights in the right location range from $2 million to $10 million, with some recent completions in this trend delivering initial IP rates above 2,000 barrels per day. The return on investment is continuing to improve. These wells cost between $5.5 and $6 million to complete, but with the really high IP rates, they produce a nice return on capital. These wells are also significantly liquids rich. So unlike some of the other plays that have gone after gas with the lower gas prices at $2 or less, these liquid-rich plays come in, much like our Adams-Baggett play, when it comes in at $6 plus per MCF, calculated against typical NYMEX. We'll continue to pursue this opportunity until the right capital source can be identified. But we wanted to make folks aware that we are looking at things that are outside of our smaller working interest opportunities. These are some pretty exciting stuff in this play. Now let me address the company structure. We've had some questions regarding that and how we're going to fund our projects, and I want to address that in the last couple of slides here. The company holds a 50% interest in an entity called Aurora Energy Partners. The other 50% is held by a group called the Navitas Energy Group, which includes several of Victory's initial investors, seasoned oil and gas investors, and a host of other high net worth individuals and private partnerships with access to capital. The partnership that underlies the Aurora agreement has been in place in some form since Victory acquired its first asset at Adams-Baggett several years ago. The Aurora partnership provides a reliable conduit to capital for the near-term needs of the company. It has also been a primary source of capital during the rebuilding effort that's taken place over the last few years. Back in December, we signed an amended partnership agreement with Aurora Energy that defines new terms and conditions for additional capital provided. $15 million of ongoing investments and increases Victory's interest in the partnership to 50%. All of our oil and gas assets reside in this partnership. Victory is the managing partner and is not restricted from obtaining additional capital from sources outside of this arrangement. You can get more details about this partnership arrangement in our SEC filings that were done in the annual report. In conclusion, I'd like to make a couple of points. We covered a lot of information during this presentation. Sometimes we can glass over going through it, but here are some salient points to remember. Everything we've discussed today represents an attractive investment for you to consider. We have a reliable access to capital. We're in the early stages of what we expect to be a rapid growth phase. With the Lightning prospect alone, you can see the size of the growth that's possible. And the turnaround effort that began a few years ago is now behind us. We're now focused on exploration and production and being a real oil company, not focused on the rebuilding attributes that we had to deal with over the last few years. It's an exciting time. We have a backlog of assets that should begin generating more meaningful results this year in the form of reserves, production, and cash flow. We have a relatively strong balance sheet for a company our size, and we've already begun to dramatically lower our G&A costs. We have a strong management team guiding this process, and we have an excellent pipeline of oil and gas projects on the horizon. Putting all that together, we believe we have the tools in place to generate significant shareholder value. As a management team, we're keenly focused on executing the strategy that we've discussed in this presentation and turning that potential value into a reality. That concludes our presentation for the day. Thank you for listening. We'll now be answering some of the questions submitted through the web portal. If you haven't submitted your questions yet, please do so now. We'll begin answering the submitted questions in just a brief moment. Okay, I'll take the first question. Can you elaborate on the next 3 month drilling plan? That would specifically be May through June, I guess. Pretty exciting opportunities in the next 3 months. On the drilling schedule, as I said, we've already have the Bootleg 2, the second well of Bootleg Canyon, being drilled. It's currently being completed, the drilling is underway. It should be completed in the next week or so and prove that project up pretty well. In May, we have the Chapman Ranch, the first well going down there. That should spud any day. We'll have a second well although it's outside of the 90. The second well will spud in August. Our Clearwater project, we have a fourth well that's scheduled to spud this month and a fifth well that should begin to spud in June. We're also evaluating some other prospects that we may slot in the June timeframe. The big well will be the Lightning prospect, and that well will begin to spud in August if the plan and availability of rigs and such stays the same. Mark, we have a question from, I can't quite read the name. It says, well, where do you see revenue growth over the next 5 years? You want to take that one? It's from Althea Wallace. Mark, are you with us?
Yes, sorry, I was talking. So that's from Althea, and so where does the revenue come from over the next 5 years? So, I mean, basically, we're expanding our footprint now in West Texas and Southeast New Mexico. We have a pipeline of opportunities there, many of which Kenny's talked about, whether they're conventional or whether they're resource plays. But I mean, that's the geography. It's going to be that part of the country where our expertise is and where our relationships are, where we'll continue to build out the company in that way. And over time, as Kenny said before, you're going to see our average working interest percentage go from 3 or 5 or 10 to 25, like with the Lightning project, and even higher. So with that higher working interest stake in quality prospects, long life oil reserves, that's going to drive a sizable, company changer kind of revenue stream over time. That's the plan. So hope that answered your question.
Okay, great. Thanks, Mark. Let's move on to the next question from C.M. Phillips. It is, could you comment on your debt, if any?
Well, I can start, Kenny, if you want. And yeah. Right now, if I look at our debt at March 31, you haven't seen the 10Q, but it'll be published shortly. And I like the figure that's there. It's a 0. And so just to reiterate, our debt, our senior secured debentures were converted 100% to common shares on February 29th. So at that time, we became debt-free. So that's where we are now. Now, again, over time, we may get capital infusions and or new debt, but having removed that from the balance sheet, opens a lot of doors in terms of being able to get new financing. So debt is 0 today.
Thank you. There is a similar question from Althea Wallace. Where will cash come from to continue and expand operations? Let me address that one. We have, as I said in the presentation, an agreement with Aurora Energy Partners. And in that agreement is a group called the Navitas Energy Group, a group of sophisticated investors and a couple of partnerships that have a focus on oil and gas. They have a opportunity to invest $15 million in the company through a specific set of terms that are in that agreement. We think for an early stage company like ourselves, the terms are good, and we're going to pursue the capital that's there as fast as that group can make the investments take place. We work very closely with them through the partnership to make sure that they're aware of our planning and our drilling schedules on a forward-looking basis, so that they have adequate time to review the things with us and put the capital in when needed. We are also working or speaking now with outside institutions that focus specifically on oil and gas. There is a tremendous dynamic in the market where if you have an asset that you currently own and it's in a very active drilling area, several entities are totally focused on just providing capital to a drilling program with a set of terms that vary from group to group. With the addition of the Lightning prospect, it really is a first project that we are 25% interest holder in, and as I said, could potentially drill out there for 2.5 years with the downspacing. So that's the background on the access to capital. We're pretty confident that we can grow the company at the pace we want and get access to capital at the rate we need it. There is a Mark.
There's a question from Michael Iorlano, and it's, what do you expect gross revenues to be for this year? So we will typically not predict a specific revenue figure, Michael. We just can't give that level of guidance. But I can tell you that last year in 2011 that our net production was about 8,000 barrels of energy equivalent, and this year at minimum that same figure will be 25,000 barrels of energy equivalent, and as high as 45,000 barrels of energy equivalent. So that's quite a multiple over last year. So you can see that the top line revenue will be affected by that kind of multiple. So that's about as much guidance as we can give right now.
Okay, I'll take the next question. What do you see as the most significant catalyst going forward? I'm not sure, other than ranking by project, what can deliver the biggest value. There's a different way to do that, I guess, but I would look at this in the context of reserves reserve growth being a catalyst. All of our properties obviously have reserves, but in many cases you have to prove those reserves out, or in all cases you have to prove the reserves out through drilling. If you look at our acreage position specifically, you can go to a Bootleg Canyon and see over 4,000 acres of opportunity there. As we drill that out, we'll begin to add what we believe are proven undeveloped reserves. We'll drill them, they'll become proven developed reserves, and begin to connect property where we can then start bringing in additional PUD opportunities from those proved wells. We also have obviously the Lightning prospect, which is probably the most significant opportunity near term because of the 25% interest that we own in it. We're quite excited about that one. And then we're looking forward to seeing the final results on the Moss well as it unloads. As I said, the analogous well that we used when we decided to drill that was at 4 BCF and over 90,000 barrels of oil. That's a nice reserve, and we own 10% of that. So hopefully that'll come into play here shortly. I think that, again, another opportunity on the biggest upside is not having the drag of the focus on the old turnaround effort. Management team's now totally focused on exploration and production, and I think that focus is what will deliver the best value to everyone. All right, let's move on to another question. We have a question from Scott Kodak. Depending on the success of your business plan, do you anticipate having to add many in-house employees, or would you be utilizing outside or outsourced manpower? Can you speak to Victory's short-term and mid-term human resource needs, if any? What type of personnel will you need? I'll take that one. We are a non-operator, and what that means is we don't have a big building with 100 employees in it doing operations and rig management and those types of things. We, as a non-operator, have a small staff, 3 full-time employees. We're about to add a couple of more. But the focus is primarily on the analysis of the deals and creating relationships with the deal sources so that we have high-quality deals that you've seen come into the company in the last half of last year and into this year. When we, as it talked about when we were looking at the shale discussions earlier, when you do your research on operators in a particular area, and the operators are the guys who are out there drilling the wells, doing the completions, managing your cost at that level. The quality operator that you pick is as much about how their completion procedures are producing results, what those results look like in terms of the windows that we like to see for investment. So in terms of employee growth, I don't see us having a huge amount of growth this year, although we do have plans as the company grows to slowly bring in resources and start operating some of our own assets. That will probably start with some of our internally generated prospects that we talked about earlier in the presentation. Let's take a question from Chase Andrew. What's being done to increase liquidity in the stock? There's several things happening there. The biggest issue in the market right now for us, in my mind, is of the 27 million shares that are out there, about 7.5 to 8 million of them are actually in the trading base every day. The company used a private placement and a combination of other sources over the last few years to get the rebuild done and to get all of the legacy past stuff behind us. That private placement raised over $5 million and created about 20 million shares of stock that was issued behind it. The exact numbers are in our annual report. Those are round numbers, and I'm guessing while I'm sitting here looking at this presentation. Those 20 million shares are going to have to begin to move into the market and out of their 6-month restriction zones, I think, before we have enough shares on the market to create the volume we need. But we're also doing things like this through Monk Media to make sure that the retail and investors and some brokers are aware of who we are and what we're doing, so that we can begin to build a nice trading base or a trading floor. Through our investor relations group, we're also beginning to go out and speak directly through a series of presentations with retail brokers to begin to build the awareness. There's a heck of a story here at VYEY Energy Corporation when you look at the last 3 years, and specifically what's been done in the last year and a half. There are oil companies on the over-the-counter market in the OTC today that don't have the assets we have, don't have the management team we have, and don't have the reserves we have, that have stock prices in the $3 and $4 range with equivalent 27 to 30 million shares on. So a big part of creating liquidity and volume is just continuing to get the word out and executing on the plan we've got. We have another question. Will you elaborate more on objective to leverage internally generated prospects? Do you intend to be the operator? We've touched on that briefly in an answer a couple of questions ago. Internally generated prospects are important because we have technical ability, obviously, to review deals and do the economic analysis and decide whether or not our risk tolerances are right and the payback is right to acquire a deal or acquire an interest in a deal. When you are doing internally generated prospects, you are producing the deal. In this case, our initial focus is here in Texas. We've acquired 3D seismic. We obviously already have the internal scientific resources we need, and the relationships with external companies that do reservoir analysis and things like that we can outsource some things to for second, third opinions. When we produce an asset, we'll produce an asset by acquiring a lease after we've decided there's a play there. We'll then typically own 100% of that in the beginning, which gives us the bigger control of the mineral interest, obviously. And then we'll put together a play where we can farm out or sell, in many cases, and produce another revenue stream by selling a portion of that to other people on a promoted basis. So we'll recover all of our internal G&G, all of our geology costs, exploration costs for seismic, all that kind of stuff when we sell part of the deal. As mentioned, I guess exampled in the Adams-Baggett case, when you own 75% or 100% of a prospect, it doesn't have to be a 300 barrel a day well to produce significant income. As you saw in the Adams example, 30 barrel a day well, which doesn't seem like much when you're talking about it. 30 barrel a day well, when you own 100% of it, can produce $500 to $1 million a year of income to the company. That's significant. The first well we're looking at is in that range, and as soon as we get the acreage acquired, we'll announce it, and you'll begin to see the value of internally generated prospects. We're excited about that. Next question. David Shirley, are you planning actual agreements and time frames in place with the operator of the Lightning project, ensuring that this play is evaluated in a timely fashion and not delayed due to rig availability? Absolutely. The operator and this one is also a 25% interest holder. So one of our key kind of decision-making tools when we decide to do a deal is making sure that the people that are promoting the deal or found the deal, or in this case the operator, have risk in the game. And what we like about this play is the operator is outstanding, Unitex Oil and Gas out of Midland, Texas. The CEO of that company has been in Fortune magazine. Just an amazing organization. They have a group of people, and they have an extensive operating history. We've already begun working on rig schedules. We have an AFE, so we know exactly what the costs are for the type of well we want to drill and complete. And the permitting has already begun. I think we're confident that we can make the August deadline. Our biggest objective right now is to let Unitex do their job while we're placing the 50% of that project out to a third party through a farm out. But we right now don't see any issues with rigs availability that will move in August date. But we'll keep the market updated as we learn more.
I'll take a couple of questions.
Okay, go ahead, Mark.
So Chase Andrew asked how much is currently being spent on R&D, and that he observes that there appears to have been a significant decrease. But so Chase, with a company our size, we don't directly invest in R&D, but we leverage the knowledge that larger operators or service companies have. So we're basically paying for their R&D through the rates that we charge when projects are undertaken. But we don't have R&D per se on our income statement. And then another question is from Derwin Wallace, and so what is the...
Hey, Mark, after this question, let's wrap up and move into to the pose booth, okay?
Oh, okay. So Derwin asked, what is the margin on your oil and gas? And so I would just say, Derwin, that typically when you look at a revenue stream, and you can see what the commodity prices are in the market, but production taxes for oil are about 4.5%, for gas about 7.4%, something in that range. So that percentage of revenue, your lease operating costs run 3 or 4% of revenue. So with those deductions, you can pretty quickly derive what the gross margin from production or producing operations are. Now from that, so that would give you your gross margin. But again, from that you would deduct exploration cost and G&A. But the gross margin at the field level is pretty darn high. All right, Kenny.
Okay, let me close by making one last comment. If you're trying to find a comparable oil and gas company that's used our strategy and grown, I'd encourage you to look at a company called Northern Oil and Gas. They have a lot of similarities to us in terms of non-operator positions and doing some of the same things we're doing in early stage. So go take a look at that. With that, I'd like to say thank you for participating. The session's now going to move